So we're back on the show. Thank you for staying with us. It is not surprising that the ports have been identified as the next potentially highest revenue generator for Sri Lanka, following tourism. Expanding trade in the Indian subcontinent and its growing integration with the rest of the world has created demand for enhanced port facilities, giving Sri Lanka an opportunity to increase volumes and market share of transshipment traffic. On The Voice of Business this week, we focus on the port sector and the progress being made on Sri Lanka's port development program, as well as the role the port sector is playing in the country's post-war infrastructure development. Here's Benchmark's Anushan Selvaraja with some interesting insights.
Welcome to this week's edition of The Voice of Business. I have with me economist and LMD columnist Samantha Amarasinghe. Now, Samantha, in your column in LMD, which releases this week, you focus very much on the port sector and the role it is playing in Sri Lanka's infrastructure development program. Can you elaborate on this?
Sure. Sri Lanka's port sector, as you know, is poised for rapid growth, and we should all be excited by the prospects and of the future potential of this sector. It has been identified as, as the next highest potential revenue generator for the country following tourism, and we have projected ports revenue to almost triple from its current levels by 2015 to almost 72 billion Sri Lankan rupees, and this is largely due to increased capacity. As you know, one of the key challenges in Asia is weak infrastructure, so this current push to develop ports, both the Margampura and Colombo South Harbour port, is likely to be a huge game changer, as it will allow Sri Lanka to benefit from increased trade, particularly from the rapidly developing markets of the Indian subcontinent. Approximately 17% of total capital expenditure is earmarked for ports development. And no doubt this is money well spent, as large-scale projects of this nature have strong multiplier effects in terms of both direct and indirect employment generation.
Now, Standard Chartered's November 2010 research publication, the Super Cycle report, notes that South-South trade has risen to 18% of world trade from 7% in 1990. Can you tell us more about this and also explain the synergies that there are?
Firstly, I'd like to begin with defining what South-South trade actually is. When we speak of South-South trade, it refers to trade between emerging markets, and it essentially comprises trade between Africa, developing Asia, Latin America, and the Middle East. South-South trade is a sustainable trend, as there are many trade synergies among emerging economies, and we believe that by 2030, South-South trade could increase to roughly 40% of world trade from 18% currently. And it has been expanding rapidly, largely driven by growth rates above the global average in both India and China. So you might be wondering why all this focus about South-South trade. Well, it has been growing at an average annual rate of around 4.8%, and the combined economic output of the South accounted for approximately 45% of world GDP last year. So it is clear to see that the South offers markets for trade and capital investment with immense potential for Sri Lanka.
How confident are you that we will meet our fiscal and FDI targets this year, Samantha?
Well, FDI inflows did surprise on the upside in Q1 at $236 million, considering that the full year 2010 saw it close at around 500 million. While we do believe the government has taken comprehensive steps to provide investors with greater clarity on investment guidelines and regulations, we feel that more work needs to be done if the authorities are to achieve their $1 billion FDI target for this year. Notably, FDI inflows in Q1 were heavily concentrated just in two sectors, tourism and telecommunications. As for the fiscal deficit target of 6.8%, it still does look somewhat ambitious to us. Although revenue collection increased in Q1 on stronger growth in tax revenues, which were largely due to tax reforms announced in the 2011 budget. Expenditure was higher, causing the deficit to widen to about 2% of GDP. So if this current trend does continue, this would translate into an annualized deficit of around 8% of GDP, suggesting that state spending will need to be tightened somewhat if the 6.8% target is to be achieved.
That was Samantha Amarasinghe speaking to Benchmark's Anushan Selvaraja. Thank you for watching our show. Do join us again next week at the same time.